What's up, guys? Jonathan Rose, owner, Masters in Trading. So, one of our earnings trades, Stitch, is releasing their earnings results after the close today. So, let's go over the trade. Stitch, SFIX. Now, this is just a proprietary indicator that I had built. And what this shows is the movement of the stock after its previous earnings releases. So, you can see here, here's where the price of the stock was. Here's where the straddle was, the expected movement of the market. And here's what the stock did. It broke out of the straddle. Same thing here. Gap down, broke out of the straddle. Here, it barely did on the downside. Here, it got right to the upside a little bit. Now, right here, stock's at 23.20. Here's what the straddle is pricing. So think of it like betting an over-under in a football game, right? You can bet the over or you can bet the under. It's a binary outcome. Well, the straddle, if you sell the straddle, you're expecting the stock to stay within these two lines before the stock expires in 16 days. If it gets out, you're going to benefit by buying the straddle. Now, this trade was shared May 19th. So it was shared about 25 days ago. And the original trade idea was 24 strike buying the straddle for $4. Right now, the bid on the straddle is $4.30, offered at $4.60. The reason we got into this is because SFIX historically moves considerably more than the options are priced. If you can find an opportunity like that, you want to buy the straddle. So right now, we were able to buy the straddle 25 days ago for $4, $4.30, $4.35 mid-market. I like holding this trade through the earnings release. But what's so important, and many people don't realize you can even do this, is if you have an options position and there's going to be earnings after the close, you need to manage that position after the close. So 23.18, if you're long 10 straddles, that means you're long 10 calls and you're also long 10 puts. You can think of that if it's at the 24 strike. Think of yourself like you're long 1,000 shares from 24 and you're short 1,000 shares from 24. If the stock rips up to 35, the puts, you have the option to be short. You're not going to accept that option, but you are long 1,000 shares from 24. So here's what I strongly suggest you do if you hold the straddle or if you hold options. If you own the straddle at 24, 10 times, I personally would consider offering 300 shares at 28, offer 300 shares at 30, offer 400 shares at 32 or 32 or 32.50. The same thing on the downside. 18 or 17 and a half bid for 300 shares, 15 bid for 300 shares, 13 bid for 400 shares. I would put those orders in the order book after the close today. Why would we do this? Well, after earnings release, SFIX is going to be volatile. There's going to be crazy prints, just like here. What happened here, right? Earnings were released like at $27. It went up to 38 before coming back down to 32.5 and 30. Same thing here. There is going to be illiquidity after the earnings release. If you're offering stock, you might get filled. The worst thing that could happen to us is if the stock gets up to 37.50 like it did here and then comes right back down. This person missed that awesome opportunity to get out of the trade or to scalp gamma, to manage their options using stock. So it's important to work stock in the market after the close, which will help manage your options. If any of my members have any questions about this, we do this every earnings season. I need you to email me, support@Masters in Trading. We're releasing earnings, or SFIX is releasing earnings after the close. So get in front of your questions. I'll make sure I get back to you before the close today. Okay? Great trade. It's working really well. I would stick with it. Remember, if you're long 10 calls from whatever strike, think of it like you're long stock from that strike. If you're long 10 puts from whatever strike, think of it like you're short puts from that strike. Okay? Hope it helps. As an aside, We do this every earnings season. This is the only way I'll ever do an earnings trade, is to back test and look at the previous movement. So SFIX, we have the previous movement. The average of the last 4 earnings moves is 33%. Right now, the market's only pricing in a 15% move, but it's averaged 33%. Hopefully you can understand the massive amounts of opportunity for us. We have edge. If this thing moves 25%, we're going to do really, really well on this trade. If it moves 20%, that would take it up to 27.50. We're going to get filled on our first level. Always backtest, always see how stocks have moved previously during their earnings, and then you can look and see how the options are pricing in the implied volatility and see if the implied is pricing in enough movement that would cover a stock's historical movement after earnings. Okay? Any questions? Leave them in the comments. My name's Jonathan Rose, owner, Masters in Trading.